Allora tra 30 secondi si parte con l'episodio. Prima però, sì lo so, gli spot non piacciono a nessuno. Però tranquilli perché tanto questo non è uno spot. Infatti non vi dirò che se volete investire in azioni ed ETF a bassissimi costi, Scalable Capital è la soluzione scelta da oltre 1 milione di risparmiatori. Non vi dirò neanche che si possono fare piani di accumulo illimitati a zero costi d'ordine e che Scalable paga degli interessi sulla vostra liquidità senza alcun vincolo. Si applicano termini e condizioni, investire comporta dei rischi, clicca sul link che trovi nella descrizione dell'episodio e buon ascolto! Secondo te si era capito che era uno spot?
This episode is brought to you by Progressive Commercial Insurance. Business owners, meet Progressive Insurance. They make it easy to get discounts on commercial auto insurance and find coverages to grow with your business. Quote in as little as 6 minutes at progressivecommercial.com. Progressive Casualty Insurance Company. Coverage provided and serviced by affiliated and third-party insurers. Discounts and coverage selections not available in all states or situations.
Welcome back to The Bull, your personal finance podcast. This episode couldn't have come at a better time. Right now, the whole system seems to be starting to creak. On Monday 27th, we woke up to what seemed like a hurricane, DeepSeek, the new Chinese artificial intelligence model that shook all the big American tech companies. They thought they were light years ahead in this field, only to get a rude awakening. Compared to what happened over the weekend, though, DeepSeek was just a gentle tap. Donald J. Trump had been saying throughout his campaign that he would impose tariffs left and right, and so he did. First victims, Canada, Mexico, and to some extent, China. In particular, the 25% tariffs on imports from Canada and Mexico came as a shock, especially since both economies rely almost entirely on trade with the United States. And Trump has already threatened further measures, particularly against the European Union. The markets, as expected, didn't exactly react with a smile. Until the last moment, they didn't believe Trump was serious, nor that he would take such a heavy-handed approach, kicking off what could be a dangerous trade war. But let's hold off on drawing quick conclusions. The news is still too fresh, and we don't yet have enough information to say anything truly insightful. This, however, reminds us once again that an investor's life is constantly accompanied by unexpected news. There are always plenty of reasons to lose confidence in the future. Keeping a steady hand, especially when it feels like we are at the beginning of the end, is an entirely different challenge. That's why no one better than Dr. Ed Yardeni, an absolute legend in the American financial world and one of the most authoritative voices out there, can help us broaden our perspective and understand what truly matters in the long run when it comes to financial markets. I interviewed Dr. Yardeni about 10 days before this episode was released, so there will be no mention of the tariff issue. However, we had an in-depth discussion about the financial landscape, the Bond Vigilantes, a concept he himself coined, the Fed model, another framework he introduced, and more generally, about the strong case for being a permabull. Without further ado, I leave you with my conversation with the great Dr. Ed Yardeni. Dear Dr. Ed, welcome to my podcast, The Bull.
Well, you were invited me, and sounds like you have a interesting access to a big audience that's very interested in the stock market. I'm very interested in the stock market, so we can have a nice conversation.
It's amazing that you're here. You're kind of a legend on Wall Street, and I'm pretty sure you will deliver great value today. I'd like to start with the current situation. Could you please explain to us why you think we are in the roaring 20s?
Right. Well, I started talking about the current decade back in 2019. It seemed to me that there's something rhymes about the 1920s and the 2020s. And more specifically, of course, and seriously, we had a productivity boom during the 1920s. The 1920s started out very badly. World War I had ended a couple of years before that. There was the Spanish flu that killed millions of people, as did World War I. At the beginning of 1920, for about a year, there was a severe recession. So nobody was optimistic about the outlook for the 1920s back then. But it did turn out to be the roaring 1920s with all sorts of technological innovations, from automobiles to electricity to appliances, all improved the standard of living of Americans and others around the world. And the U.S. economy boomed. As a result, we had a huge stock market rally. It ended badly, which we should discuss, of course. But this time around, we have a similar situation. We've got a tremendous technological innovations. We've got a problem, which is a shortage of skilled labor. Technology solves problems. And so I think all this technology is going to be used to increase productivity. I think there's already evidence that productivity is improving. So in some ways, it's not a forecast, it's an extrapolation. This is where we're likely to go. And so I think productivity growth, currently 2%, could end up the decade closer to 3 or maybe even 4%. And that would be a big booster to economic growth. It would keep inflation down. It would be a tremendous source of purchasing power. Wages would rise faster than prices, and profit margins would increase. I mean, there's nothing bad about better than expected productivity. The only question is, will there be some events along the way that cause a recession, or will the roaring 2020s continue into the 2030s? I think that might be the case. I'm not saying there'll never be a recession again, but I think recessions don't last very long, and the outlook is really quite bright.
You were the one who made the closest prediction last year about the end-year target for the S&P 500. If I remember it right, you called 5,400s. And it was also the highest on record among the most important Wall Street institutions.
Well, I called 5,400 at the beginning of last year, and we got there by the middle of. Yeah, I was the highest, but then I raised it again to 5,800 in the middle of the year, and we closed relatively close to that level. I also got the year before that right. I think that what differentiated our outlook, why we were more bullish than most economists and strategists, is because we did not believe that there was going to be a recession, and that was the big call: is that there would not be a recession and that inflation would moderate. And so we got those two right, which then led to a correct call on the stock market. But as they say in our business, past performance is no guarantee of future returns. But we continue to work hard to try to get the markets right.
For this year, you have forecasted 7,000.
7,000 this year, 8,000 next year, 10,000 by 2029, by the end of the roaring 2020s.
Wow. Something that could cause things to fall apart may have to do with the treasury yields. You conceived the concept of Bond Vigilantes.
Yes.
Could you tell us what that means? In particular, you kept telling us since last September, when the Fed started lowering rates, that the Fed shouldn't have cut the Fed funds rate that much. Could you please expand on that?
It should not have, right. Well, I first talked about the Bond Vigilantes. I used that phrase in July of 1983. I've been doing this for a while. And during the 1970s, we had a very severe inflation, and the great inflation of the 1970s. Everything that could possibly go wrong on the inflation front went wrong. So we had a lot of inflation. And Paul Volcker came in as Fed chairman in the late 70s, raised interest rates until they broke the economy. and that brought inflation down. But in the bond market, there was a lot of fear that inflation might come back. And I argued that if the Federal Reserve and the government administration, Congress, and the president would not properly manage the economy, the bond vigilantes would step in and they would maintain law and order in the financial markets in order to bring inflation down. And it worked actually in the 1980s quite well as a way to think about the markets, because there were 3 episodes when bond yields went up on inflation fears, and then very quickly nominal GDP growth slowed down. But that was kind of the end of the famous period for the bond vigilantes, because in the 1990s, Bill Clinton was warned by his economic advisors that he had to be very concerned about the bond vigilantes, and he was scared enough that he maintained fiscal discipline, and inflation moderated, and we actually had a government surplus in the budget by the end of the 1990s. So the bond vigilantes didn't have to do much work. They got the respect from the administration. But then inflation continued to moderate thanks to globalization. The China price kept the inflation down for a long period of time. And the next time I got a question about the bond vigilantes was in 2010, when a reporter called me up and said, "Are the bond vigilantes in Greece now?" I don't know if you remember.
I do remember.
Yeah, the Greek bond yield went up to 40%, and I said, "Yeah, I guess if they're taking a vacation to Greece and they didn't like what they were seeing on the fiscal side." But anyways, Greece got its act together, partly thanks to the bond vigilantes. And then again, didn't hear anything about them from any reporters or investors asking me about them, because they were quiet. Part of that because the Federal Reserve rigged, managed the bond market with quantitative easing. But then last year, the bond yield soared from 4% to 5% in just 3 months. And that was from August, September, and October. It went from 4 to 5%. And again, there was concerns about a debt crisis. Ray Dalio, the famous billionaire investor, was very concerned about a debt crisis. And Janet Yellen, who was the secretary treasurer, said, "Okay, to the bond market, if you don't like my bonds, I'll do it in bills." So she basically lowered the maturity of the issuance of securities, and that helped to calm the bond vigilantes down, as did better than expected inflation. Inflation moderated as we had anticipated. Well, here we go again. This year, the bond yield got down to 3.65% in September 16th. September 16th, 2 days later, the Fed lowered rates, and we said that this doesn't make sense to us, because we thought that the economy was resilient, inflation's coming down, the Fed is achieving its dual mandate of low inflation, low unemployment, so why lower interest rates? Well, the Fed felt that interest rates were restrictive, and we were saying, well, wait a second, look at the stock market, look at Bitcoin, look at gold. I mean, they're not telling you that the Fed's restrictive. But anyways, the Fed just wouldn't listen to me, went ahead and lowered it not only by 50 basis points on September 18th, but also basically promised to continue to lower rates, and did so 2 more times last year. Now the Fed is probably on pause, because it turns out we were right. The economy has been resilient. It's growing around 3%. Inflation is still a bit sticky above 2%, so they haven't fully accomplished their mission. And so we think the Fed is going to be done for a while. But the bond vigilantes are watching. And I think, like Bill Clinton, Donald Trump is probably getting the message from some of his economic advisors that with so much debt outstanding, he's got to be very careful about maintaining some fiscal discipline, or the bond yield will go to 5%, 5.5%, 6%. The bond yield will go to whatever level it takes to get the politicians to realize that they've got to get fiscal policy on a sustainable course. They've got to do something to keep this deficit from just exploding to infinity and beyond.
Sure. 2 questions here. Are you concerned about the current huge amount of U.S. debt and deficit? and about the possibility the yields go up above 5%? Because sometimes it feels like 5% is the terror threshold above which things must fall apart.
Well, it's I've been doing this for over 40 years, maybe 45 years now on Wall Street, and I've always said that when the bond market worries about the deficit and the debt, I'll worry about it, because for over 40 years there's been alarmists, pessimists, doomsayers who've been predicting that the deficit and the debt would bring the economy down, and you don't want to be in the stock market, and they've been wrong. So one has to be open-minded in thinking about markets and listen to the markets themselves. And if the bond market can absorb all these securities at interest rates that aren't killing the economy, where earnings are still growing and the stock market's still going up, you have to respect that. But at the same time, there's a legitimate concern about out of control fiscal policy, which then raises the possibility that the bond vigilantes will in fact be forced to take law and order into their own hands. The reality is last year the bond yield got to 5%, and there were plenty of buyers at 5%, and it didn't kill the economy, and the stock market went on to new highs. This time around, there was a lot of talk about going back to 5% and higher, and the market got to 4.75% basically, and there were lots of buyers. Why? Because inflation news has been moderating recently. And then Fed Chairman Christopher Waller last week said that maybe the Fed still is on course to cut interest rates several times. Again, I disagree with that view, but I don't run the Fed. They run the Fed, and I have to anticipate what they're actually going to do, not what I think they should do. So that's where we are right now. I think 4.5% is right, the right level. I think is a normal, correct level for the bond market. 4.5 plus minus maybe 25 basis points. There was 4.25 to 4.75% is where the bond market should be. That's where it was before the great financial crisis. That's where it was before the Fed really started to intervene and manipulate the bond yield. But I think what's interesting, I just want to relate something to you. I have a lot of investors, a lot of institutional investors who manage money for wealthy individuals, and they all tell me that their investors are getting very nervous about being in the stock market. So I say, why? Well, they're very concerned about fiscal policy. They don't like the deficits. They don't like the debt. They think it's troublesome. So I said, so what do they want you to do? They tell me, well, our clients want us to sell stocks and get into bonds. I said, are you kidding me? They're complaining about all these bonds, and they want to buy bonds. So I think we have to take into consideration that the world has never been wealthier. There's a tremendous amount of wealth in the global economy. Just the household sector has $170 trillion in net worth, assets minus liabilities. And obviously, a lot of people want to be diversified. Not everybody want to take a tremendous amount of risk. There's a tremendous amount of demand for government securities, which still are probably the safest securities in the world.
Do you think our view has become biased by the quantitative easing from 2008 to 2021? We have been close to zero interest rates for a very long time. Now we are accustomed to thinking that having a Fed funds rate above 1 or 2% is kind of a problem.
Well, I think that I like to be. The Fed says they want to be data dependent, and I want to be data dependent too. I want my views to be consistent with what the data is actually showing. And what the data is actually showing is that the federal funds rate is where it should be. The Fed officials have this view that there's some sort of neutral federal funds rate, some sort of neutral short-term overnight bank lending rate at which nirvana is achieved. You get low unemployment and you get low inflation. R star, and they think R star is 3%, at least that's the median view expressed in the latest quarterly survey of Fed officials. And so they think R star is 3%. We're right now more like 4%. So they want to cut by another 100 basis points. And I'm saying, but wait a second. We are at 4.1% on the unemployment rate. Inflation has come down tremendously. It's getting close to 2%. Isn't it possible? Isn't the economy, aren't the financial markets telling us that we're at this nirvana rate? And by the way, the Fed cut the Fed funds rate by 100 basis points, thinking they wanted to get closer to R star, and the bond market went the other way and raised bond yields by 100 basis points. So who's right? And by the way, this whole R star idea is the craziest concept I've ever heard. Every economist on the planet Earth agrees that it cannot be measured. We know that. It's not empirically measurable. And I think almost every economist will have to concede that they're not sure that it's like the constant pi in mathematics, 3.14 and so on. It's not a constant. It changes, and it changes depending on demographics. It changes depending on global trade, geopolitics, fiscal monetary policy. So it's a ridiculous concept. It's kind of a magical mystery concept, magical mystery tool from the Beatles. But look, if people believe it, I've got to acknowledge that and play their game. And if they're going to play their game, I'm going to tell them, look, we're there. It's like the kids. You're driving to visit grandma, and it's like a few hours away, and the kids in the back of the seat saying, "Are we there yet?" And they're being very annoying. And I think we're there in terms of the right interest rate level.
The typical investor thinks about stocks and bonds as they somewhat compete with each other. And you contributed to popularizing the Fed model, the idea that the earnings yield minus the 10 years treasury yield can tell us something about how fairly priced the market is. How reliable is the Fed model for forecasting future returns?
Well, it was back in the 1990s that I talked about the Fed model. And I noticed that, I think it was in 1997, the Fed had some concerns about whether the stock market back then was overvalued. So they had a chart in their report comparing the forward earnings yield of the S&P 500, which is really just the reciprocal of the forward PE. So the forward PE is based on the earnings expectations of analysts. So it's price divided by the forward earnings expectations over the next 12 months of analysts. And that in turn is just the proxy for that, because you can't really, there is no such real measure, but you can do a proxy by taking a time-weighted average of analysts' expectations for this year and next year. And it works pretty well, especially when the economy is growing. So if you take the reverse of that, take the not PE, but E divided by P, the earnings yield, and then compare that to the 10-year bond yield, then you get a model, a Fed model of whether the market is over or under valued. Typically, when the earnings yield is very low, the PE is very high, and that suggests that the stock market may be overvalued relative to the bond market. And the model worked really, really well in the 1990s, but again, the Fed really started looking at it in 1997, and I named it the Fed stock valuation model in 1997. And then, Ricardo, wouldn't you know it, just as I discovered the Holy Grail, it stopped working. And it didn't work in the 2000s.
As usually in finance.
Yeah, just when you find something that's amazing, it stops working. And you have to be data dependent and accept that fact. There's all kinds of relationships that look, this has worked for the past 5 years, and then it stops working. So you have to be aware of that. But it seems to be working now. We have the bond yield at 4.5%, and the forward earnings yield is at 4%. So they're back in harmony, suggesting that both bonds and stocks are fairly valued. It could very easily be argued that the problem over the past couple of decades has been that the bond market has been completely and totally overvalued because the Fed was adopting QE. You can't have a market model called the Fed model, which depends on the bond yield being a market rate, that the market, it's going to fall apart. And it did fall apart in the period from the great financial crisis to the great virus crisis. So, yeah, I guess the story is one has to be flexible, and it's important to look at the relative valuation of stocks versus bonds. Also important to look at the valuations on their own. Historically, are stocks overvalued? And if so, why is that the case? And if not, what's different this time?
You said that now the market seems fairly valued according to the Fed model, while the typical interpretation, one you can read, for example, on the Wall Street Journal, is when Treasury yield is at 4.5% and earnings yield is at, let's say, 4.3%, then the equity risk premium is negative. Therefore, you shouldn't invest in stocks, which is actually not the case.
Yeah, I think that's too simplistic. I wrote a book in 2018 called Predicting the Markets, and it was basically a professional autobiography. It's what I had learned and errors I'd made and what I'd learned from the errors in the 40 years that I'd been in the markets up to that point. And my chapter on valuation basically says that valuation is like beauty. It's in the eye of the beholder. And I also pointed out that valuation can kill you. If you buy stocks when they're overvalued, you can get killed in the market. And I made the analogy to King Kong. And at the end of the movie King Kong, one of the stars says explains what killed King Kong, and he says it was beauty that killed the beast. So the same thing with valuation; it's in the eyes of the beholder. And look, I'm looking at 21, 22 as the forward PE in the market right now, and I'm a little bit nervous about those levels. I mean, we're not that far off from 25, which is where we peaked during the great tech bubble in the late 1990s, and then we had the great tech wreck, the crash in the market. But this time around, earnings are a lot better, especially for tech and communication services. And again, I've been, over the past 3 years, we've had the most widely anticipated recession of all times that never happened. And usually an economist gets some attention, some fame by predicting a recession and being the only ones to do that. This time, everybody was predicting a recession except me. And so I had a pretty good 3 years here, being on the right side of the economy, being on the right side of the markets as a result of that call. Now, what's the relevance of that to the market? Well, the market did get spooked about a recession. We did have a bear market. It didn't last very long. It was January through October of 2022. It was 25%, which is kind of a very average kind of bear market. Along the way, I said, I recognize why there are concerns, but I don't think we're going to have a recession. And recessions are what cause bear markets. But we still had a bear market. So, the last time we had a bear market without a recession was in 1987. The other bear markets have all been associated with recessions. So I think stock investors now have come to agree with me that, hey, maybe the economy is resilient. Maybe the economy has demonstrated that it can withstand these levels of interest rates. Hey, maybe these interest rates are actually normal. So maybe there won't be a recession for the next several years. And I think valuation isn't just dependent on interest rates, isn't just dependent on inflation rates. I guess some people use reversion to the mean when it's too high. Everybody thinks the mean PE is about 15. So if you're at 20, it's got to revert back to 15. And so I'm always like, that's a little too simplistic. Could it be that investors believe, as I believe, that there isn't going to be a recession over the next several years through the end of the decade? Ricardo, this doesn't come with a money-back guarantee, but I think the economy is going to continue to grow. And the longer out you think an economy can grow, the more you're going to be willing to pay in that valuation multiple, because you figure, hey, I got time for the earnings to grow and for the PE to become more reasonable.
Absolutely. The next question is about valuations. They're extremely high, at least if you consider the historical average, as long as average means anything. I think the CAPE ratio is at 38, 97th percentile, so 3 standard deviations from the mean, and a lot of people started to worry about it. And we have high concentration too. I guess that 26 companies made half of the S&P 500 market cap, and only 7 companies, we know who they are, account for 30%. Yeah. On the other side, I'm in Italy. In Italy and in Europe, our benchmark is not the S&P 500, it's the MSCI World or something like this. So we invest typically 60 to 70% in the US. But a lot of people question if it's a good idea to diversify away from the US where we have cheaper valuations, because cheaper valuations mean higher risk and we don't have that good economic fundamentals here in Europe. If you have to give us a bunch of suggestions, would you tell us to stick with our international diversification? I'm very interested in figuring out what you think about
absolutely. Look, we've been recommending overweighting the United States relative to in a global portfolio since 2010. And we haven't given up on that position. And that's been a good call. We have not been big fans of overweighting emerging economies. They seem to be able to return a big. They tend to have big rallies and then they give it back pretty quickly for one reason or another. Europe is challenged by a rapidly aging demographic profile. Europe has tried to offset that with immigration, but there's a clash of civilizations. When immigrants come into a country, it only really works if they melt in, if they accept the culture, if they become part of the culture. And instead, there's a lot of social tension in Europe. And Europe just doesn't have the entrepreneurial, capitalistic animal spirits that we have in the United States. Maybe it's because there's a lot of regulations. And Mario Draghi has gone over this and said, Europe has to change. And I completely agree with that viewpoint. Totally, yeah. That doesn't mean that stocks in Europe haven't done well. They have done well, but it's been pretty clear that the United States has been leading the way on a relative basis and also just on a trading basis. When the U.S. stock market is down a lot, everybody goes down, and when the U.S. stock market goes up, everybody goes up. So there's a lot of people who, when they see the U.S. market going up, they get bullish on stocks around the world. And they have diversified portfolios. Maybe they have benchmarks, and so other stocks do well. And there are great companies in Europe for sure that have done very well on a global basis. But we've been against investing in China, just philosophically, politically. I don't want to invest in a country that the rules of business can change, where successful executives of companies disappear. There's no rule of law, and so I've been saying that China is uninvestable, and I think that's generally worked out right. It's been tradable, but I think as an investment, it just hasn't been a good investment. Let me just commodity producers like Brazil, Canada and Australia are also commodity producers. If China is going to be depressed, relatively weak, which I think it will be for a while, maybe for quite some time, because of its aging population and because of the disaster, the one-child policy that's coming back to haunt them, then commodity prices may stay relatively low. And so it's hard to get excited about Canada or Australia or Brazil or Indonesia, Malaysia, the commodity producers in that kind of situation. The United States accounts for 65-70% of the market cap of global stock markets. Seven of them account for 30% of the S&P 500. But my assumption is the Magnificent Seven are going to remain magnificent. They're not going to disappear. My assumption is that all companies in the S&P 500 are technology companies. They either make technology like the Magnificent Seven, or they use technology to increase their productivity, efficiency, customer experience, and relationships. And so I think we are in this roaring 2020s that could roar into the 2030s with an unprecedented technological revolution. I call it the digital revolution, right? A few centuries ago, we had the agricultural revolution. Then we had the industrial revolution. I think since 1950, we've been in the digital revolution, where we started out with IBM mainframes, went to digital equipment, mini computers, then PCs and laptops, and the cloud, and now artificial intelligence. This is all about data processing. This is all about processing as much data as we possibly can, as quickly as possible, as cheaply as possible. And now we're at the point where we're able to do that. So now we're actually writing software programs because we're lazy. We don't want to, we get all this data and we can process it and come up with all sorts of relationships, but there's so much of it that we still need a program to interpret it. So what does this mean? How do we use it? How can we use it more efficiently? What can we learn from it? And what can it learn from itself? So when I talked about the roaring 2020s back in 2019, I didn't know that AI was going to be this huge technology, but it is. I mentioned that it could be, but quantum computing might be. I think it's a little bit of hype right now, but that could certainly be it. Look, we got supercomputers now that are very cheap. Supercomputers, you just put together a lot of NVIDIA graphic processing units together and you have a supercomputer. And so everybody's learning how to use this supercomputer and input all their data to increase the efficiency of what they do.
I suppose the great question now is how much is already priced in the stock's valuations? It seems like they're priced for perfection.
I'm not going to tell you that valuations aren't stretched. I can come up with explanations like no recession, and the longer that we can expect the economy to grow, the higher the PEs. But I really wouldn't want to see PEs go up from here. What I think the market is going to go up is on earnings, and I think we saw that last week when we had better than expected bank earnings, and the market had a really, really good week. So I'm counting on earnings, and I have the highest earnings on the street for S&P 500. I'm using $285 a share for this year, $320 a share for next year, $400 a share by 2029. And I think profit margins are going to go up to a new record high. I mean, this is all not so much a forecast as an extrapolation of what's actually happened. Basically we got it half right. I mean, the roaring 20s are basically half over, and things have worked out really well. And now, we're seeing some of the craziness that we saw in the 1920s with, the excitement about cryptocurrencies. I mean, the amazing thing was Trump became a billionaire again with issuing the Trump meme coin. So, that's the kind of crazy stuff that we saw back in the 1920s. But fortunately, there's still a lot of very solid fundamentals.
Beside cryptos, maybe.
Yeah. Well, I don't really have a strong pro or con opinion on crypto. I think crypto or Bitcoin, I think it's digital tulips, which makes it sound like I'm saying it's a ridiculous speculative bubble. But that's really not what I'm saying. What I'm saying is the tulip mania in Amsterdam was in Amsterdam. It was in a small city. And I think it was a market that was only open during daytime. What's different about Bitcoin and other cryptocurrencies is it's a global market, and it's open 24 hours a day. all around the world. And so as long as there are buyers willing to buy it at higher and higher prices, it's gonna go higher. But there's no, I as an old-fashioned strategist, I can't value it because I don't have earnings, I don't have dividends, interest income. There's nothing in my toolkit that I can tell you what Bitcoin is actually worth. So, there are people out there saying, well, its next stop is $250,000. And I always like to be, a contrarian. So, okay, let's make it $1 million.
Sure.
It could be anything. But so I'm not going to tell people that have made a fortune in crypto that they were wrong. They were right. I'm just jealous. I wish I'd bought some at $300 or wherever.
We all do. Beside that, there's a lot of talk about private markets. I suppose because future returns are expected to be lower going forward. And then someone says, let's move a part of our portfolio toward private equity and private credit. That reminds me of 2008 CDOs and stuff like that. What do you think about private markets and the opportunity they can bear today?
This idea has actually gotten a lot of credibility from Goldman Sachs. Goldman Sachs a few months ago said, with P's where they are now, with concentration the way it is, at most you're going to make 3% total return over the next 10 years. And historically, total return has actually been 11%, which is a nice, much better rate at which to compound than 3%. So Goldman's saying, if you don't like the outlook of 3%, come to us and we have all kinds of products that we can sell you.
Great interpretation.
So, they're not exactly disinterested researchers when it comes to this subject. I, on the other hand, don't have any products to sell other than my research, and I've never felt comfortable with private credit and equity because it's hard to price. I don't really know what the price is, and I do know that when a crisis happens, everybody wants to get out, and they're totally illiquid, so that's an issue. But look, the financial markets in the United States have become extremely sophisticated, and we probably said the same thing during the great financial crisis. Look how smart the markets are. They've created all these amazing products. And so you always want to be careful about that. But, some of these private credit funds are liquid, and they're run by very credible people like Howard Marks and people like that who've got a great track record. So, I think portfolios should be diversified. I think stocks need to be held for the long run. You can't just kind of day trade them unless you're really good at it. If you're not really good at it, then, trying to pick tops and bottoms and trade them is not a very successful way to go. I've had a really good career picking bottoms. I'm still working on tops. And I tell people, if you find somebody that's really good at picking at tops, make sure that they can also tell you when to get back in. So maybe that's the difference between perma-bulls and perma-bears. Perma-bears are always going to tell you we're at a top, so they're always going to call it eventually. Whereas perma-bulls, like I said, I've had a pretty good track record at calling them pretty close to when they happen. But I'm in the Warren Buffett, Professor Siegel camp that really believes that stocks really are designed for long-term investors. You want to compound the interest. You want to see your portfolio grow over time. It's kind of like what we saw on Star Trek, Spock, whenever he greeted anybody or said goodbye to anybody, said live long and prosper. That's really the motto for stock investors. Buy stocks, buy them when you're young, keep putting more and more money into them, and then live long. And if you do that, you're going to be rich. And that's one of the reasons we have income and wealth inequality in America, is because the baby boomers, people like me, when I started my career, I was at the Federal Reserve Bank earning $20,000. And even back then, that wasn't a lot of money. But my rent was $500 a month. So, I could live on it. But I've done pretty well over the years, and I've lived long and prospered. And a lot of my colleagues and friends and other people in the baby boom generation have done well too. But again, the household sector in America's never been wealthier with $170 trillion, and half of that is held by baby boomers. And a lot of them have stocks in pension funds. They've held them for a long time.
I would have asked you what makes you a die-hard permabull, but you have somehow already given the answer.
I'm not a diehard permabull, but I'll say this. I try to be objective. I try to be data dependent. I try to look at the data and then come up with a conclusion, rather than the other way around. It's not that I'm a diehard permabull. It's the stock market. It's a diehard permabull. I mean, bear markets don't last very long, and it has been a long-term bull market. I think when I first started my career, the Dow was around 1,000. Now it's around 44,000. My only regret is I didn't have a lot of money when I was young and put it all in the stock market. But when I do my work, I try to look for a balance between what could go wrong and what could go right. But what I noticed is I don't really have to do a lot of work on what could go wrong. And the reason I don't have to do a lot of work for that is this: you got a lot of perma bears who are just always bearish. They cannot tell the bullish story. Hey, if you wanted me to spend 45 minutes with you telling you how the world's going to come to an end, I know their story. I study it. I crib from them. They do great work, really, on what could go wrong. And then when I said, okay, so what are they missing? And I can't come up with anything else that they're missing on what could go wrong, but they're missing everything on what could go right. So as a result, I kind of wind up being a perma bull. I've said it before. I'll say it again. When I die, I want my tombstone to say Ed Yardeni, and I hope it says something like born 1950, died 2050, and I want a nice 100 years. And I hope it says something like Ed Yardeni was usually bullish and usually right.
Wonderful. I read that great article you have written a couple of months ago about perma bears against perma bulls, and I loved it. And I cited it in the podcast. Taking inspiration from that article you have written, why being a perma bear makes you look smarter if perma bulls turn out to be right most of the time, at least in the long run?
That's a good question. I don't know. Maybe it seems to people that somehow being bullish or optimistic is naive. It's not, but it's not naive at all. I mean, things have actually worked out pretty well over the years. And so maybe just being a pessimist and, maybe it's because, if the stock market's going up and somebody's warning you that it's going to go down, that sounds smarter. Whereas if the market's going up, which it tends to do more often than not, then, then you're just playing the probabilities. So I guess you have to be smart to get the bear markets right. But the problem is the perma bears never really do. They're very often very early on seeing the bear markets, and then they never get you back in.
Eventually, there will be a bear market.
And the fact of the matter is, a lot of these perma bears have been around for a long time, and they're still in business. So there's a market for these perma bears.
Dr. Yardeni, thank you so much for your time. It was precious.
You're very welcome. And if I may, if anyone wants to have a look at our research, they can just go to Yardeni.com. And for individual investors, you might want to look at YardeniQuickTakes.com, which is aimed at providing a daily insight into what's moving the markets and what might move the markets one way or the other in the future.
Yeah, great content there. Check out Yardeni research for great insights into the markets, and you'll find the link in the episode's description. And once again, thank you so much for joining my podcast.
Well, Ricardo, thank you very much. I enjoyed it. Thank you.
Bye-bye.
Bye-bye.
And that's all, folks. I hope you enjoyed this episode and that Dr. Ed has filled you with the same energy and enthusiasm he gave me while listening to him. From the bottom of my heart, a big thanks to Ed Yardeni, and a reminder that you can follow all his market analysis on the Yardeni research website, which you'll find in the episode's description. As always, I invite you to hit follow and turn on notifications on Spotify, Apple Podcasts, or wherever you are listening, and to leave a 5-star review to support us. That helps us keep producing contents that explain why in finance, if you want to sound smart, you should be a pessimist, but if you actually want to be right, you'd better always be an optimist. That's really all for this episode. I'll see you next Sunday for another session together, right here, of course, on The Bull, your personal finance podcast.